One bright spot in the real estate industry right now, retailers are expected to open 1,000 new stores this year at a time when inventory is at an all-time low. That's sending rental prices up, the price per square foot in the highest in about a decade, about $23 a square foot, according to CBRE. Joining us right now to talk more about the health of real estate is Don Peebles, the Peebles Corporation CEO and chairman. And Don, it has been a very long time since we've gotten the opportunity to talk. What are you seeing right now? You are somebody who's been in real estate for a very long time. But what Diana just mentioned, lowest demand for mortgages right now because of mortgages prices going up, and what you're seeing in real estate writ large. Just lay it out for us.
Sure. Well, on the topic of single-family home, for example, or residential property, two things are driving that. One, interest rates are extremely high now, relatively speaking, to where most Americans who have purchased a home in the last decade or refinanced have very low interest rates, and therefore they're not willing to sell. And then in addition to that, COVID and then these rising interest rates have constrained new development. And so you have a combination of those two factors severely restricting supply. And that's the biggest thing that's driving the market. People need a place to live, but major markets around the U.S. have significant housing shortages. Where we also are seeing a big change in the market is where we are in terms of commercial office space. There was a sense of optimism last year, the year before, that as COVID wore off and people got back to their lives, that people would come back into work. And there's been a lot of resistance to that. Technologies enable us to do a lot more remotely. And so if you look at the top 10 U.S. markets in the country, 52% of the office space is vacant, and unoccupied. 1 in 5 buildings are vacant and unoccupied. So what the question is that what do you do with that space? Because these markets have relied upon people coming into the market each day to go to work and then consuming products and services from the businesses in those locations, like Manhattan, for example. And so there's a big shift now and a big focus on can we convert a lot of those empty office spaces into residential use and address the severe inventory shortage in the marketplace.
There's a story in the Wall Street Journal today that says the good news is firms are actually signing new deals. Leases are up, but a lot of times they are for fewer floors, less space than they had been before, significantly less space. And these are leases that are for up to 15 years. So you are locking in this idea that people are going to need less space. What does that mean for commercial real estate overall? Is it going to need help? Is it going to be other people who come in and take over existing properties on some of these situations? What happens? How does this play out?
Well, all office buildings aren't treated equally, and they're not created equally. So Class A new office buildings in markets like New York City, Los Angeles even, are doing relatively well. It's the second and third generation, the B and C buildings that are, devastated. And those buildings are going to have a tough time coming back. And so there'll be a search for alternative uses. And you're right. The tenants, the law firms, the financial services firms, businesses as a whole are constricting. They're reducing the amount of space that they are occupying or that they're leasing when their leases roll. One hidden thing is the federal government. Only about 25% of the federal government workforce is actually going to work in their offices in the Washington, D.C. metro area. And the federal government leases over 50 million square feet in that marketplace. And those leases, while they're long-term, they're subject to annual appropriations. And so ultimately, I think you'll see Washington, D.C. have significant headwinds on the commercial office space. So ultimately,
for commercial office space owners, but maybe good news for taxpayers who aren't going to be shelling out as much money for this?
Yes, actually, there will be, because the federal government is paying, billions of dollars for office space that it doesn't occupy. And so it will ultimately have to cancel some of these leases. And that's going to create greater difficulty for the Washington, D.C. market that relies on it. But I think that there's a great opportunity here. Many buildings will get repositioned, and I think we can start addressing the workforce housing challenges that major markets in the country have had.
Don, let me ask you about one more thing we've been talking about today. Big banks and now even mid-sized banks are going to be facing additional regulation in terms of what they'll be allowed to loan, how much capital they'll have to have on hand. Some of the big banks are saying that could put them in a position where they're not going to be able to do as much commercial real estate leasing. How does that play out, and is that a big problem?
Well, that's been happening for a while. I think in the development space, where we occupy most of our business, the banks have been low leverage lenders, and they have been less competitive. And so what's happened is the private credit market has stepped up over the last 2 to 3 years and before COVID. And now, again, they're stepping up. We just closed a deal in Charlotte for a development deal on one of our projects about 2 weeks ago, and it was with a private credit lender. So you'll see private credit step up. I think that'll affect bank earnings, by the way. And I think these banks, because 80+% of the commercial real estate loans are held by local and regional banks. And I think that there's going to be some significant pain because kicking the can down the road isn't going to solve these problems with office space. And the apartment buildings, they're also at risk because, I mean, these interest rate caps are going to burn off. The swaps are burning off in about a year or so, and we're going to see also a lot of pressure there, too.